Hi everyone, welcome back to the Property Finance Podcast, and one of the most listened to episodes I've ever done is an introduction to bridging finance. Obviously I recorded it near on 5 years ago, and quite a lot of people have come back to me and said, look, even that's quite high level, could you explain bridging to me as if I'm a 12-year-old? So I'm going to take that quite literally, and I am going to try and explain it as if the people listening to this are 12 years old. So in terms of, I've written a little bit about kind of what bridging is. So originally bridging was used to chain break. So imagine your friend has got a rare Pokemon card. I really am going as if you're 12 years old here. Imagine they've got a rare Pokemon card. They found it on eBay. They really want to buy it, but their birthday money doesn't come in for a couple of weeks. So you agree to lend them the money to buy that card until their birthday money comes in, and then they give you that birthday money at the point that comes in. That essentially, in a nutshell, is what bridging finance is. You are essentially plugging the gap to cover a shortfall of funds or an incoming sort of chunk of funds. That's what bridging finance was used to begin with. So people would find the house that they absolutely love, their dream home, family home. We want to move into this, but our house hasn't sold yet. A lot of obviously this happened in sort of 2008, 2009. So they would go and get a bridging loan. The bridging loan would then pay for the house that they wanted to purchase, and then at the point that they sold their existing house, they would then pay off the bridging loan. That's what it started off as. Then as the years have gone by, so over the last 10, 15 years, bridging finance has kind of evolved into more of a tool for property investors. So you don't actually see many people using it anymore for chain breaking, really, which is what it used to be, mainly because people expect transactions to take longer and not as many bridging lenders are interested in sort of financing those sort of short-term deals. And obviously the expense of it, many people just look at it and say, well, actually, we'll just wait and find another house. And the amount of houses being built and everything else, there's not such a urgency behind things anymore. So over the past 10, 15 years, it's sort of developed into a tool for property investors. So what happens is property investors will now use it to cover properties that are unmortgageable, so properties that don't have a kitchen or bathroom, for example, or that are in a bad state of disrepair. And a lot of lenders deem unmortgageable as something that can't be tenanted within 30 days. So if there's quite a heavy refurb to be done, if there's damp, mold, all these sort of things that need to be dealt with before a tenant can move in, that will essentially deem them as unmortgageable. So that's where bridging finance sort of developed. And even so, over the last sort of 3-4 years, bridging finance has continued to develop into a more creative financing tool. So we can now bridge against market value as opposed to purchase price. So people are now using it for bridging below market value. We can use it to bridge the back end of option agreements. We can use it to bridge the back end of lease options. We can use it for all sorts of auctions. Maybe if there's a distressed vendor, for example, and speed is of the essence and you need to complete within a week or so, again, that's where bridging finance can come in. So hopefully that's a really, really quick explanation of bridging finance. So very aware that it's been sort of 5 years since I've updated that episode. A lot of people have come to me and said, look, can you sort of explain it to us like we're 12, hence obviously the Pokemon card reference. So hopefully that's given you a bit more of an idea of what bridging finance kind of is and how it can be used. And like I said, there's an episode from 5 years ago which goes into a lot more detail around the fees, the interest, and the previous 150 odd episodes that we've got here as well have also gone through kind of the fees, interest, and everything else. But for those of you that don't want to go back and listen, I would say fees and interest, you're looking 2% arrangement fee, 1% exit fee, and on average sort of 0.89 to 1% a month as an interest rate. So yeah, we've got the bridging finance calculator on the website, which for those of you that have never used that, it's a great tool. Obviously I'm biased, but it's a great little tool. So if you go to the propertyfinancecollective.co.uk, have a look in the middle of the page, it will say Bridging Finance Calculator. Have a look at that. You can put some basic numbers in and it will very quickly churn out a set of sort of indicative bridging terms, which you can sort of get your head around and understand how it's all structured and how it all works. But like I said, plenty of resources to go back over. But Bridging Finance, very much a very, very creative tool that every single property developer and property investor should have in their arsenal. If you've enjoyed the episode, please do leave a review. Please share it on social media as well. It'd be great to get as much exposure as possible on the podcast at the moment. But otherwise, that's it from me. Catch you on the next one.